Mustafa, for opening remarks as well. So today we will have 9 panels, more than 30 speakers, 2 keynote speeches. It's going to be really diverse. So for the first keynote speech, I would like to welcome Mr. Peter Randall on the stage. He is the CEO of Settle. So let me talk a bit about himself. He is the founding CEO of ChaiX Europe. So if anybody who doesn't know ChaiX Europe, that's one of the best trading platforms in the Europe. One of the best, I mean, in terms of volumes transaction. So it's one of the 5. So could you please come onto the stage, Mr. Peter Randall? So his keynote speech will be about the platforms, and subsequently he's the CEO of Aqueduct. He restructured the business and turned it into the fastest growing platform in Europe to 2012. So welcome on the stage. I'm really excited to know you, by the way.
Ladies and gentlemen, good night. It's always a privilege to join with Pinar, Dr. Emmerdag, who I have immense respect with for having worked with for many years. I think we first got together back in 2005-06, and Pinar is both a visionary, but also, more importantly, a really practical business person. And I think what Fintech is all about, really, is about practical business solutions to complex problems. Now, I'm just going to leave this up for a moment. This is not intended to be advertorial or anything else. It's just a description of the Settle blockchain actually working. There it is. It's doing 34 million transactions a day. It's taking less than a second on average to process those transactions at this point. And we're writing blocks every 5 seconds. It's operating from 5 nodes globally. I just want to leave that for a moment whilst I give some overall general remarks. So the first place I'd start is that we're living in really interesting times. And from a financial technology point of view, the most interesting piece about those times, as far as at least I can see, is that we're living in an environment where the major economies around the world have been pumping money for about the last 7 years. Quantitative easing has created such vast pools of cash that interest rates have effectively gone to 0, and therefore the opportunity to find yield in other instruments has become absolutely essential. Ladies and gentlemen, those of you who've lived through more than one cycle will know that the great thing about cycles is that interest rates go up, they go down. They go up, they go down. And that's exactly, I suspect, what is going to happen here. So when you're thinking today about some of the things you're going to see, ask yourselves the question, is this, and to what extent can it be determined by the fact that money is available at almost no price? Because I suspect a lot of the things that we mistake for progress are just an example of very, very low interest rates. That's one of the most important things. Always bear in mind at the back of your mind that quantitative easing is creating such amounts of cheap money that financial technology is kind of like almost parasitic about that. But when interest rates go back up, ask yourself to what extent some of these business models are going to be significant. Next thing I would say to you is bear in mind that some of the solutions that have been very interestingly discussed, and I'm sure are going to be discussed again today. Let's talk about something, let's say, like robo-advisors, something I have a particular view on, right? Robo-advisors, really clever. You can have a computer system that will work out what it is that an individual investor wants to do. Ladies and gentlemen, how soon will it be before any of the really big hedge funds crack the algorithms that the robo-advisors are using and just to start investing ahead of them, front-running them? A week? 2 weeks? A month? Almost no time at all. So ask yourself then the second question, and the second question I would contend is really very straightforward. And the second question is simply, is what we're proposing to do now actually going to make a difference? And Can that difference be sustained? Because very often, a lot of the things that are out there don't actually make a difference. They're a solution, but what to? To a problem? Maybe, maybe not. So those are just a few opening thoughts as we go into this space. And I think the most important part about this space, the absolutely most important part about it, is to think a little bit about history. Because I think it is the fact that those of us who don't necessarily live in history but think about it, can see some very interesting opportunities as they begin to develop. Now, let's assume that this is all going to work. Way! And it does. That's fantastic. I'm really pleased about that. So, think about history in this way. Effectively, every decade, every 10 years for the last, certainly 5 or 6 years, 5 or 6 decades, we've had something new come along in financial services. In the 70s, it was SWIFT. SWIFT was revolutionary once. SWIFT, as you know, is the messaging service that moves cash between banks. Massively compromised recently, possibly criminally compromised. Certainly lots of problems with it, but certainly very, very, very embedded in the system. In the 1980s, it was the dematerialization. Now, I know that sounds very technical. What dematerialization is effectively removing your name from a share certificate, taking it off a piece of paper, and putting it into an electronic ledger. In the 1990s, it was the establishment at central banks of what are referred to globally as real-time gross settlement services, RTGS systems. And virtually every central bank in the world runs effectively the same system. That's very important. In the 2000s, it was a work that Pinar contributed to, and a lot of people in this room contributed to, with fixed protocol, FIX. The work that we did at that time really, I think, underpinned an enormous amount of the explosion of front office technology in the decade beginning 2000. Remember that ICE was only formed, ICE, the largest platform in the world today, was only formed in May 2000. BATS didn't exist. Chi-X didn't exist. The biggest markets in the world in those days were the New York Stock Exchange, now owned by ICE. The London Stock Exchange, BATS Chi-X is bigger. Deutsche Börse, BATS Chi-X is bigger. In fact, I think BATS Chi-X is probably going to be bigger even after London and Deutsche Börse have merged. But that's a different issue. So we say that the decade of the noughties, if you will, was the time at which super fast technology was dropped into the front office. And what I mean by super fast technology is it was replacing COBOL-based systems running on mainframes. So when we started to have a little think about what we think is going to happen in this decade, we said to ourselves, so where are all the COBOL mainframes living today that run on that run systems? And of course the answer is in the back offices, is in the post-trade space. So we think that the decade is going to be, this time it's the turn of post-trade. Why is that important? It's really, really, really important because banks have got some phenomenally big problems. We say they've got 5 problems. The first problem they've got is that their costs are up. Costs across the banking industry have been growing inexorably, far, far greater than their revenues have. Why? Because? Well, because very often regulators have said you've got to have a whole lot more compliance specialists. You've got to have a whole lot more technology risk management people. You've got to have a whole lot more regulatory affairs specialists. Very expensive, because they're all lawyers. Your revenues are down. Why for? Because the very same things that you used to be able to use your balance sheet for, you're now no longer able to do. Then we say there's something that happens that's like a stone in your shoe. And we all know what a stone in your shoe's like, right? It's really irritating, because you've got to stop, you've got to take your shoe off, and I bet, if you're anything like me, when you get a stone in your shoe, it's always raining. So you always put your foot down on the wet pavement, and you always get a wet sock. Well, the rest of the day is ruined. You've got a wet foot. The stone in the shoe for the majority of banks today, ladies and gentlemen, are things called peer-to-peer lending, things called peer-to-peer FX, things called crowdfunding. These are not things that are fatal to banks, but they are things that are very irritating because effectively they're creaming off a lot of really exciting margin. The fourth thing, really serious. Since 2008-9, according to work done, I think it was by Bloomberg or Reuters, since 2008-9, the top 20 banks globally have paid over $325 billion in fines and levies. So you're running your bank, your costs are up, your revenues are down, somebody's running off with all the really juicy business, and the regulator turns up and says, you know what? I'm going to fine you for not being able to respond to this particular inquiry in a timely fashion, or whatever else. Really, really difficult. So the post-trade environment is pretty central to sorting things out for banks. The final thing, if you look at John Crine from Deutsche Bank the other day, said that they operate, I believe, over 200 separate systems. Just the complexity of technology within major banks these days, because of the silo effect that has grown up over the years, has become really, really difficult. So, talked about history. I think it's a good place to start, because I'm going to try now and illustrate from an entirely different point of view, the principal features of financial technology, the principal features of how actually, as a society, we've been doing these things for many, many generations. Those of you who know, this is from the Louvre. In fact, everything's from the Louvre. It's a cuneiform tablet recording land ownership in Assyria. Down here, these, I don't speak cuneiform, but down here, I'm told those are witnesses. They're the witnesses that actually that land transfer took place. Witnesses, land transfer, moving an asset, having somebody else know what you're talking about. Blockchain, ding, ding. Does that make a connection for people? Maybe it does. Maybe it does. Now, the next picture we show is this one. You'd be forgiven for not knowing who this was. I'll tell you. It's in the Louvre. It's very, very rarely seen because they keep it hidden, because it's actually quite embarrassing for them. It's Philip IV of Spain, King of Spain. Very powerful king. It was in the Louvre, and about in the late 1900s, they gave it to, the late 1800s, they gave it to some new restorer to try and clean up. Wasn't a very good restorer. And as you can see, he kind of wiped out the face. So if you want a record to persist, which is, bing, bing, blockchain, if you want a record to persist, ladies and gentlemen, what have you got to do? You've got to make copies. You've got to make copies. So here we've got one in the Louvre, Philip IV, badly restored. We've got the Met in New York, we've got one in Boston, and we've got, of course, the one in Prado in Madrid. Back in the day, before a literate society, the only way of proving who the king was to hang a picture of the king all the way around his kingdom. That was how it worked. Back in the day, that was a distributed ledger. That's actually what we're talking about. There is a copy of what was essentially the way of communicating to the kingdom who the king was. And that's really, really important. Now, of the smart people in the audience, and I'm sure all of you are very smart, a lot of you are probably saying to yourself, yeah, well, that's really interesting. Yes, I understand about witnesses. Yes, I understand about copies and all the rest of it. But he's not said anything about the chain, has he? Yeah, well, I'm going to say something about the chain. So there's the chain. This is the family room. This is the family room. And the family room, of course, has the pictures of the parents and the siblings and the children and everybody else that was related to the king. So now, if you wanted to pretend that you were the king, you could have your picture painted, of course, and you could have your picture distributed all the way around the place, of course. But anybody then going back to the family room and saying, well, yeah, but where's the picture? Show the parents, show the grandparents, show how it actually originated. And that, of course, is chaining it all together. So that, if you will, is the blockchain. That's a chain which, we have lived with, as an example, for many, many years. I'll leave you with that thought, and I'll leave you with a number of other things. Fintech is really important for a very simple reason, that in order to help us grow out of the current very low interest rate, therefore very difficult for banks to get sensible returns, contributing to ROEs of less than, return on equities of less than 6-7%. In order to do that, the thing that is most desperately needed is innovation. And in today's environment, innovation can come from many, many different sources. I've been privileged to have worked with some of the best innovators in financial services over the years. I've been privileged to have led some of those things. And I can tell you that most importantly, asking the question, and I would say that this is the key to success almost, is ask yourself the question, by and large, not can we do this, not even should we do this, but if we do this, will it make a difference? If we do this, will it make a difference? And don't mistake, just because you can, does mean you should. Because there are plenty of products that we see that are really, really interesting and solve some really, really interesting things, but they don't actually make a difference. So it's the trick is to actually test yourself in the real world about how does this make a difference. Ladies and gentlemen, with great pleasure, I have addressed you today. I will be around for the rest of the day. We have got that demo that we showed you at the beginning, which works, which shows real-world volumes, real-world activity. And more importantly, it acts at real-world speeds. Some of the things you'll hear today, I'm sure, will be people who kind of think that putting up lists, hundreds of lists of, this is a really important initiative because it's got 5 banks involved. Nah. This is a really important initiative because it's got 25 banks involved. Nah. This is a fantastically important initiative because it's got 45 banks involved. No. Why not? Because what does that actually mean? In most cases, that just means talking. What would you rather do? Talk about it or do it? If you're doers, get on and do it, bring it to the market, and it will work. If you don't know what to do, the next best thing is to talk about it. And you see that all the time. So there's this initiative, or there's this collaboration, or there's this particular view of the world. So many people talk about it. So few people have got working technology. Actually, you know what? If you want this to work, you've got to have the technology. But the technology is not by any means the answer to the whole thing. And don't believe anybody that tells you it is, because they're talking hooky. The thing that is the answer to the whole thing is a really simple recognition that the project is much more complicated than that. The first part of the project is to understand the regulatory environment into which the project will be offered. And in fintech, the regulatory environment has got to revolve around being able to undertake KYC, know your customer, and AML, anti-money laundering. So identity is critical to that. Speed is critical. There's not a bank on the planet is prepared to bid for XRP Ripple coin in order to book a slot in which they can do their trade processing. Why not? because the regulators won't allow it. You have a very, very limited window between a trade and then getting that onto your books and records. Why for? Well, because that's prudentially regulated. It's something that's quite important. You can't just do a trade and then sort of wait for half an hour while the XRP price comes down. Nah, that's not going to work. So the most important thing to think about is the regulatory thing. But the most important thing to deliver is the community. So this is not about fintech per se. It's not even about regtech per se. It's a horrible thought, regtech, but it's not about regtech per se. It's about building the community. It's about getting a bunch of people together in a room who would normally want to kill each other before breakfast and getting them to collaborate long enough to produce something that is of general benefit. Ladies and gentlemen, my time is up. Thank you very much indeed.